This is The Bottom Line. The Bottom Line on 938 Live.
Observers say Singapore's export-dependent economy will turn in dull growth this year. This is because despite a recovery in exports to the US, demand in Europe remains stagnant, while Japan slipped into a recession. For the first part of the year-end wrap on Singapore's economy, Travis Teo reports.
The warning signs came early for the manufacturing sector. In March, US semiconductor company Broadcom shifted some of its operations from Singapore to Ireland, while Renesas Electronics said it will be moving operations to Japan and Malaysia. Senior economist at DBS, Irvin Seah, says these are costs to the economy during this transitional period.
The entire economy is still trying to adjust to this new norm in this economic restructuring process. So some of the lower value manufacturing clusters are certainly bearing the brunt. They're seeing compression in their margins. I believe many companies out there are toying with the thoughts of whether they should relocate to a cheaper manufacturing cost country. They have to face up to the competition in a global market. So they need to remain competitive. And if costs of productions continue to go up, that will probably force some company to relocate.
Overall, the Ministry of Trade and Industry is forecasting full-year growth at 3%. Experts largely agree with that forecast, but economist at UOB, Francis Tan, says they'll be at the lower end of the 3 to 5% annual growth projected by Singapore's Economic Strategies Committee in 2010.
I think that's considered quite a steady growth path that we are seeing, particularly coming in the current environment whereby we are thinking that the Eurozone and Japan are seeing recession. And Japan is already in recession, and these two are our major trading partners. But nevertheless, I'm still optimistic that we can at least achieve a 3%.
Meanwhile, despite the ongoing push for higher productivity, it contracted by 0.3% for the first half of this year. Edward Lee, Regional Head of Research at Standard Chartered, says productivity remains elusive.
I think we should realize that our productivity levels are not low. Within Asia, we're possibly one of the higher ones in our productivity levels. So there's no simple low-hanging fruits for us to just use and grow our productivity easily. And second, demand side of growth is not strong. Hence, I think without this demand pool and productivity still proving elusive, it will be a bit hard to sustain high wages because you can't have high wages without increase in productivity.
Analysts say the way forward is for the government to continue concentrating on micro measures to boost productivity. These include providing more help to SMEs, presenting opportunities for training, and funding automation for companies. Looking ahead, lower oil prices are likely to give a leg up to Singapore's economy. Mr. Tan of UOB calculates the possibilities.
There was a study done by the Central Bank in Singapore, and that was actually back in 2009. So there was an estimation that if oil price declined by 10%, that will actually add 0.1 percentage point to our GDP in the first year and a 0.6 percentage point in the second year. So what does this mean? Okay, this means that, well, currently I think oil prices have dropped around 40%. So that means that in 2015, there's an upside of 0.4 percentage points to our baseline forecast. Now, we are thinking that 2015 Singapore's GDP should come in around 3.3%. So 3.3, if you add another 0.4, that will mean actually there's upside towards 3.7% GDP growth in 2015.
Officially, the Republic is forecast to grow by between 2 and 4% for next year. Tune in tomorrow at 8:50 in the morning and 5:50 in the evening for the second part of our year-end wrap on Singapore's economy, where we'll be talking about inflation and the cost of living.
Travis Teo there with the first part of our year-end wrap on Singapore's economy in The Bottom Line.